Ryan Nunes, and we're live. How are you?
Good, Zach. How are you? Thanks for having me on.
Yeah, no, I'm excited. I think you are a great candidate to teach this class today, back to school series of finding the right deal for you. And so if it's okay with you, you're going to be the professor for the day.
Sounds great.
Yeah, so, as we go into class today, I think, let's just start off, give a few minutes about yourself. How did you get into the position where you are? I know you left the corporate world. Give a little background about that.
Sure. I grew up in the East Coast outside of Princeton, New Jersey, did my undergrad at Georgetown University, finance and international business with a minor in French, and then started working at a power company in a management rotational program. So my last rotation was on their commodities trading desk, got really interested in commodities, was doing my MBA part-time at NYU in the city, and was rubbing shoulders with a lot of folks that were working on Wall Street, had an opportunity to join a Wall Street bank in commodity sales, and was just at the right place at the right time. The oil markets really took off. That's when the shale boom, which was kind of like the internet .com event, it was just huge revolution, step change for oil and gas. And so I was right in the middle of it. I was very successful in my career and moved to a number of Wall Street banks just on a series of promotions, and became one of the youngest managing directors by the time I was 30 at a prestigious Wall Street firm, and led a team of 5 folks and covering the Americas for oil and gas sales. So basically calling on different oil and gas producers and airlines, anybody that had commodity price exposure, and helping them lock in their price of fuel. For real estate folks, it's when you call and lock in your interest rates. That's what I was doing, but I was on the other side of the phone for folks that were corporations looking to lock in their prices of commodities. So did that for 13 years, just had a really good time as the market was changing. The past 4 years of that run was thinking about what else could I do? What is my I was in my halftime of my career. What is the second half going to look like? And so I'd looked at a lot of different things in terms of opening up franchises, starting schools, music schools, just things that, passionate about, and very passionate about teaching as well. And so when I learned about multifamily, I was like, this is it. And I had a fair amount of income that I wanted to tax shelter, and I just couldn't believe the tax advantages in multifamily. So kind of jumped all over it and joined 2 folks on 2 different deals, and just under 400 units. 238 in Athens, Georgia, and 154 in DFW. So, and got my hands real dirty. That's all I wanted to do, was just learn the business and really apply what my Wall Street background to multifamily. And so, became one of the co-asset managers on both of those deals, and, just really saw within the first 2 months, how much of my skills transitioned well to the multifamily space. And so, then, invested passively, and with the goal of tax sheltering some income that I had. And along the way, I decided that just given my background, and was looking for someone with a similar background that had gone through the Wall Street boot camp, and partnered with a gentleman that was an M&A banker, former private equity. And we, also did his undergrad at NYU. I did my MBA there, and so together we've teamed up, and we've looked at some 200 plus deals. And I've offered on a number of properties, particularly in the Texas Triangle as our focus area. So it definitely took us some, time to kind of narrow, the box of what we were looking for. And, the more deals that you see and the more deals that you analyze, I think that helps to focus in on what you want. And so that process for us was really helpful. And then deciding, okay, well, how do we get to quicker no's, quicker yeses, and, very fast maybes. And so, that was kind of our goal, and how do we make this as efficient as possible? So, during this COVID-19 that's been going on for a number of months, we rebuilt all our models and leveraged some teams from overseas, as well as just spent a lot of our own time thinking about what are the points that make a deal good in our eyes, and what are the things that cause us to have hesitation and pause, and how can we spend more time on the things that we like and less time on the things that just out of the box will never sit well with us. So, and that's what we did. And, some of those things, I am here to share what we found.
Yeah. So I think, as you said, get to quicker yeses and quicker nos. And so what was the, when you came from Wall Street, what were the foundational things that, as an investor you were looking for that helped you establish your operating model of how to do due diligence on finding deals?
Yeah, I mean, honestly, the number one thing, and I wrote about this in 25 questions every passive investor should ask. I mean, 80+% of the deal is a sponsorship team behind it, because if you don't trust them, then just walk away, because they can hide anything that they want to hide. They can over embellish or overstate anything they want to overstate, and they can understate things that are really important. So, from that perspective, it's really, do you like, know, and trust the people that you're investing with from a passive investor standpoint, as well as, going into a deal and partnering with other folks, because when you're co-signing on a loan, these deals are marriages. I mean, it's been nice to see people in and out of deals in 1 to 2 years, but I just don't think that's the norm, particularly in the period we're in. We kind of think about it as a 5-year hold, and, are you comfortable with that, a liquidity for 5 years? And so, just going back, if you're on weekly calls or twice a week calls, you just have to make sure you know, and have a fair amount of confidence in the other people, on the phone with you. So I think that's number one. And that's also, I would say it's a very Wall Street principle. People do business. What I found is that we might not have always had the best price on our commodities desk, but people would do business with people that they trusted, and they felt that they were getting a fair deal with, and, someone that was going to be there when there were problems, or someone that was going to be there, to hold someone's hand through a process. So, I think that principle still, very much holds true in multifamily as well as other businesses.
Yeah, so I mean, you're looking to, as a passive investor and someone you want to invest with as a GP, are you taking on a limited partnership from people that you like doing business with as well? Is it like a two-way street?
Yeah, I guess, from a limited partner perspective, as you're a general partner, you want to make sure that people truly understand what they're getting into. I remember vividly having a call with someone, and she was like, well, I want to invest with you, but I want to be in and out in a year. I said, unfortunately, this is not the asset class for you. I mean, to get in and out of a deal in a year, some people have done it, but it's more the exception than the rule. And so you have to be comfortable knowing that, there's going to be, the hills and valleys in multifamily. And, we've already seen it. We're seeing it in this COVID period where collections, for some assets have dropped. I know our occupancy dropped, but fortunately it's rebounded, significantly since the lows. And it's just part of the business. And so you have to have that stomach to wear those things, and understand that this is going to happen, and it could happen at least. And you have to make sure that, as an investor and as a GP and as a limited partner, you have the liquidity to withstand those things, and that you have the comfort, the stomach to be comfortable in those environments.
Right. And so, as you are going, because you probably have to go through, I would think 100 deals to make an offer on 10% maybe.
Yeah, that's typically what our ratio has been. Yeah, about 1 in 10 deals we're offering on. And for those 9 that we're not, we've really tried to cut it down, because we just found that, spending so much time looking at deals, and how can we get to that quicker yes and quicker no? And that was really our goal.
Yeah. So walk me through that process.
Yeah. So, I'll just maybe looking a little bit more at the screen here as I kind of walk through a slide deck that I put together. So, for us, our investment criteria, and I think this is what, we had to find this, and it's evolved over time, the more assets that we've looked at, but, it is 80+ units, kind of number one, 80+ units. And with that, we prefer pitched roofs, individual HVACs, and brick assets versus stucco. And just for, maintenance reasons, for, also tenant reasons in terms of, the pitch roofs because of look, and then also, just leaks and so forth, individual HVACs, just so that tenants have control over their, heating and cooling. And then the brick, just because it's, I really feel that stucco assets should trade at a discount to brick, just given maintenance issues and so forth. Mm-hmm. And 80 units plus, just because that is, a good size where you have more third-party managers that would be interested in managing that asset. Number 2 is our focus is B and C class properties in the Texas Triangle. And, a number of reasons why we like the Texas Triangle is that, there's more than 1,000 people a day moving to Texas. And, given the economic turmoil that we're in, we still feel that, the migration from the coast to Texas is going to continue to happen. And, I'm kind of a product of that. I moved from New York to Texas to Houston about 10 years ago. And, we've had many opportunities to move back, and we have all our family there, and we just came back from a vacation, but we've really decided that New Jersey is a place for us to vacation, but Houston is home. And, I think that once people move here and they see just the work, live, play, balance, and just good equilibrium, and no state income taxes, it's quite compelling. And so, number of Fortune 500 companies here, it says 53 of 54 Fortune 500 companies are in the Texas Triangle. So out of all the Fortune 500 companies in Texas, headquartered in Texas, and then 7 of the 10 largest universities are in the Texas Triangle in those 4 cities. So what's interesting as well is the GDP of Texas is roughly the size of Canada. So just a great story. And, if you buy an asset, and if you buy it in the right place, then you have that, kind of wave of support, the wind at your back for performance. And so, picking the area, I think, is probably the most important decision besides picking the right partners and sponsors. And then we look for median household income greater than 35,000 to 1 mile radius. Kind of had an example here, what I call dream demographics. This was a deal that we looked at, and the 1 mile income. This was a class, I would say it was a 1965 asset, which, typically would be Class C, but it was in the Class A plus area. So your demographics were just under 99,000 in the 1 mile for the median income, and the home values were over 400,000, with some homes over 700,000 or $1 million plus, just right near the asset. So, when we look at the median incomes versus pro forma rents, typically, leasing criteria is that the income has to be 3 times the monthly rent. And so, the monthly income 3 times the monthly rent. And so this was 6 times our pro forma rents were the median income was 6 times our pro forma rent. So just a lot of cushion and a lot of folks that would be eligible to live at the property. So, we like assets that have strong demographics, loyal tenants. So you can see that on the rent roll and how long they've lived there, and that are near schools and retail. So again, that kind of live, work, play scenario. And, for sure, we prefer properties that are 2 beds plus. And that's typically, one of the things that we look at. If there's 1 beds, typically you'll see kind of whether that's, construction laborers or single folks that can just pick up and leave to a hotter area. So we like more family oriented properties so that the tenant base is more sticky. So then, in terms of location, assets in the path of progress, I just kind of have a picture here of, this is one property we were looking at. There's 2 H-E-Bs, and there's 2 Starbucks, there's a Sam's Club, a Lowe's, Ford dealerships, Honda dealerships, just a ton of, retail and shops and, potential jobs for the tenant base, as well as 4 schools nearby, 2 churches, 3 churches. So just a lot surrounding the asset, all within a 1 or 2 mile radius. So, those are things that we really, really like. When, we also look at what's the crime. And so in this screenshot, low crime obviously is safe communities, happy long-term tenants and owners. This is an asset, just as an example, that we looked at in Dallas, where, we toured it. We really, we liked it. But when we started looking at the crime stats, every week, this is kind of a weekly snapshot of what's happened in the area every week. And I just pulled this up over the weekend, and sure enough, there's 2 shootings right by the asset. So it's really a war zone. And so, you can change the asset, but you really can't change the location around it. So again, kind of picking the right location is so key in real estate. And I think that residential theme of location, location, location definitely follows through to multifamily. And so, those kind of the shooting and the crime is, by and large, it's outside of your control. The area is much bigger than your individual asset. You can, screen your tenants better and so forth, but still, if there's a neighboring property that isn't doing that, it just kind of spills over to yours. Then we look for value add opportunities. So nothing distressed, nothing less than 80% occupied. So, we want to see assets that have, performed well. I mean, our investment criteria at this point is really for that lower risk part of the spectrum. We're not looking for 50% occupied, needs 20 a door rehab. I mean, really something 10 a door rehab and under is what, fits us best. And we aren't vertically integrated in the sense we have a construction company and the like. So I think that's best handled, the 50% occupied, 20 plus a door rehab is best handled by folks that are more vertically integrated. And then we look at, in terms of operating history, to understand how the deal has performed is looking at, the T12 and saying, okay, what does vacancy look like? What does concessions look like? What is loss to lease? What's bad debt? So I had a chart here of a deal that we looked at in DFW that, for us, we try to get as much inside intel as possible to make the most informed decision as possible. So we actually talked in this deal. We talked with a previous owner that had sold it to the gentleman that owns it now, owned it for just under 2 years, and had just really struggled. He had to re-tenant the whole property, had a number of CapEx projects that the city made him do that he was unprepared to do. His bad debt, was running in January or June 2019, a year ago, was just under 14%. It was 13% in August, and then November was 10%. And then it quieted down, but you just, think about, well, did it quiet down because he's holding something back for the new buyer? So things like that would just cause us to dig deeper and really question, why is the economic vacancy at one point topping 30% here? So those are things that we try to really understand the history of the asset. And again, we've built tools to really rip through these things very quickly. And so we get a very accurate picture, but very, very quick. And then, on the tax adjusted expense normalized cap rate, we're looking for 5+. And, we like the story of going into an asset 5+ cap rate with debt in the low 3s or sub 3. And great, areas like the Texas Triangle. So, that's something that's important to us. A lot of brokers, a lot of folks will send us something and they'll be like, oh, this is an 8 cap rate. And then you realize, once you adjust it for expenses, because, they don't put in property management fees, or the payroll is the guy, working for free at the asset, it's, cell phone. So, things like that, you have to adjust and normalize the expenses. Also, just with property taxes having increased dramatically this year, and, that's just something that needs to be accounted for. So you just need to make sure that, or for us, we like to make sure that we're buying something that makes sense given our criteria. On the flood map side in Houston, this is really relevant, is, having lived through Harvey and just seen, how devastating it can be. Fortunately, I didn't flood, but, we really shy away from, if anything flooded, it's kind of, dead on arrival. And if anything's in 100-year, that's kind of DOA. 500-year, we've looked at some assets there, but it just has to be a really, really good story. And then why is that flood zone just equals higher insurance costs and more operational risk. So, people say, okay, it flooded, we were able to rebuild the units. That's great. But that also just takes more time and headache. So if you're choosing between 2 assets and one's in a flood zone and one's not, and one, that there's the risk of flooding is going to be way lower and your insurance expenses are going to be way lower. I mean, that just, to me, seems like a much better deal if it's the same price per door. And typically, we just haven't seen a heavy discount on assets that are in a flood zone or have flooded. So, we would want to see a significant discount for something like that. In terms of, the last and final test, I have a picture of my 2 kids. They're 8 and 10, and I call this my kids test. So we'll take them to the apartment community and ask them, just see their reaction, and they're pretty vocal about things. So what are their first impressions? Do they feel safe, and would they want to live here? And then I just had a quote as well. We try to teach our children about life. Our children teach us about what life is all about. And, a large part of getting into multifamily and kind of alluded to the things that I was looking for earlier, but one of them was, we always hope our best for our children and that they go to great schools, but, being able to be, the captain of your own destiny in terms of acquiring the assets that you think are going to perform well. and being able to leave that legacy for your kids and train them and teach them some real tangible hard skills. And that is a huge motivating factor for me. So, I've shown them a number of apartment complexes, and, my daughter's really into kind of rehab projects and making things look interesting. So she loves watching Chip and Joanna Gaines. So, their first impressions are pretty interesting, because typically, that is going to be the first impression of a prospective tenant when they drive up to the property. So, that's kind of, the hows and whys of our criteria and the things that we look for and the things that interest us. So that's what we try to kind of describe to brokers and paint that picture. So, it helps them save time, when they're saying, hey, here's an asset that, could fit. And, frankly, we've looked to pay up for assets that fit that criteria because we believe in them so much. So, we place a premium on them in pricing. So, those are the things that we find interesting and would love to see more of.
Yeah, no, that makes sense. Like, why does certain criterias have an impact on you being a father and having kids and wanting to make sure if they were to live there, it would be a good community for them? That's why you may focus on location, like you said, low crime rate. Are these criterias have a connection with you as an investor, but also as a father?
Absolutely. So, I kind of tell a funny story. I lived outside of New York City when my first few years working in the city. And I remember walking home from night late after work, and it was a rougher part of town. And, some guy walking up the street, here's me, okay, walking. And this guy just randomly, never met him before, don't even know who he is, just swung at me, just uppercut. Yeah. Luckily, I was quick, and I almost felt like my whole, body just bent back.
Matrix.
And yeah, it was crazy. But from that, it's like, yeah, it's okay. And I didn't move, I moved later on because we moved to Houston, but, that didn't faze me as much, right? But, with kids and so forth, it's just different. And I think, when we're targeting communities, where we're trying to build community, and we're, looking for, families that are going to be more loyal and sticky. And, we have to make sure, safety is primordial. So, hence that picture of kind of the war zone that I showed is something that is just kind of a non-starter for us, because, sometimes we've even heard lenders, one story is a lender just drove a property at the 11th hour, like a week before closing, and just dropped the deal. And that's crazy. So the guy went from agency to bridge overnight. And, so things like that, where again, if you buy, those areas, they may change over time, but, it's just adding more risk. And if you're not getting more return for that risk, it's kind of like, it doesn't make sense. And I often find that there's a lot of things in multifamily that don't really make sense to me in terms of, and there's not a premium for the return, but there is a risk premium. I.e., you're taking more risk, but the return isn't commensurate with the more risk that you're taking.
Mm-hmm. Yeah. So, as you were underwriting deals and looking at your criteria back in 2018, 19, what has changed in your underwriting model to have the implications of COVID in 2020 and onward moving forward?
In terms of underwriting, we really look at total income and just keeping that. We don't know what the next year is going to hold. Our view, so to account for that, is we'll have typically really low growth, maybe to no growth in total income from the T12. And, when you think about that, that's pretty conservative, because you're taking over property management. You have the ability to, whether, drastically cut expenses, implement a very strong and sound business plan, potentially do rehabs or even delay them, but add some amenities, add some more community feel to the property. And for all of those things, you're just keeping income, conservatively flat and hoping to outperform. But to investors, saying here's what we're going to underwrite is to kind of a flattish year one total income growth. So, that's one thing that we've been doing, just because there's a lot of uncertainty. Despite the stock market's going crazy, and some people in a camp of, the world is never been better. And then there's other people, in the camp of, this is, kind of the end time. So, and, we just want to be conservative, particularly in the next year, but we do, again, to the point of this is a 5-year hold. So, and when you're buying these assets, you're buying them for 5+ years, and you're putting on debt that may be, 10 years, just because 7-year debt doesn't really seem to make sense, just where it is on the yield curve, and what investors or, lenders are asking for. It seems it's either kind of 5 or 10. And so if you go with the 10-year, then, luckily you have that cushion to whether, if this drags out a few years or it's more severe. But you just want to make sure, if you can get as much IO as possible, that helps. But hopefully there's some very highly visible value add stories. I mean, some things that we look at is, one deal that we bid on was, we talked with 3 or 4 property managers about the deal, and all of them came in with significantly lower expenses than what were on the T12, which makes us feel really good. And that property had three people on it for, sub 90 units, which doesn't make any sense, right? So instantly you can cut payroll. So that's highly visible, right? Versus, okay, we're going to bump rents $200, kind of field of dreams and hope that everybody comes. So what is the quality of the value add, I think is a big focus. And, and oftentimes just having another partner we kind of do these pitch sessions where, someone will take a lead underwriting the deal, and then they'll kind of have to sell it to the other person. And like, if they fall apart trying to sell it, then, like, investors are going to find cracks in the deal too. And so that's really helpful. And I think, why this is such a team sport and a partnership sport, because, that having that sounding board to bounce an idea off of somebody that you really know, trust and respect is super helpful.
Yeah. And so of all the criteria you said, what is one that is so vital, but you sometimes can get loose on? And you have to be really disciplined, saying, no, hey, I know this is important. I need to stick with it. And it has saved you, on so many deals when you look back.
Yeah, I mean, I think what's tough is on the unit size. I think that's one thing where we kind of fluctuate. And the reason why we fluctuate sometimes is because, we do have some property managers that will do smaller units. And if something is local, i.e. here in Houston, I do have this vision of one day self-managing assets. So, there's an opportunity to, start with something small. And if I have good visibility on, hey, this can reduce my taxable burden by XYZ, then it's like, okay, here's a great asset. And what we find though with the small assets that make the deal fall apart is just when you burden it with expenses. Even if you put property management fees and payroll on a 50-unit asset, typically we just feel that they're, unfortunately they're overpriced. So you're not getting, to my point of, you're not getting compensated for that risk. And I mean, there is more risk with smaller deals. I mean, when you look at what's happened with forbearance and so forth from the agencies, it's kind of been 5x what your larger deals have been in terms of forbearance. So, those stats, there's a reason why that is because, smaller deals, you have a few people move out, and that hurts your income much greater than those same few people moving out on a 100+ unit asset. So, but that is right here where we slide a little bit, just a little bit more opportunistic there.
Yeah. I mean, as I'm talking to investors, everyone's looking for the value add play. I think it's been moralized in these past few years, and they know that's where the opportunity is. Do you see that your strategy is going to have to change more of a yield play moving forward, or do you focus on value add through, like you said, getting efficient in operating costs, decreasing expenses, and just raising your rents as they typically have done?
Yeah, I mean, that's a great question. So, I would say there's a spectrum of, and I think my hands are reversed here, but if there's a spectrum of like deep value add and, 20,000+ rehab-a-door, less than 50% occupied or so to, something that is more of a yield play. I mean, I think we're closer to the yield play in terms of our investor preference. And, we want some value add. And even if that's light value add, if there's opportunity to cut expenses, if there's some rents that we can bump or just manage the property better, I mean, that is still exciting for us. And I think particularly when you lock in, I think the fundamental story is if we can buy a great asset in a great area, not to overthink this, but great asset, great area, and you can put on low cost debt, we like that story, right? I mean, yes, we have all the analytics in the world to throw at something, but that is the fundamental story for us is low cost debt, asset in a great area. And if you're cash flowing, 7, 8+%, I mean, the treasury right now is at 50 or so basis points for the 10-year. I mean, it's fantastic. So I think investor expectations need to realistically change. And maybe that changes with this pandemic as people see that, their pro formas have all gotten dinged. And it's been a little bit more of preservation of capital and distributions have, been cut or, suspended. And just people realizing that, yes, if someone's promising to pay you 15% a year or something, I mean, there's a reason that they're promising to pay that. The deal must have a lot of risk. So, so those types of things. I mean, if a deal has a lot of life to it in terms of, it's a great area, by schools, kind of all those great demographics, it'll always be attractive to another buyer. So, we feel that there'll always bid for the asset. There'll always be a bid for the asset no matter what happens to the economy. So, we're very open to yield plays.
Yeah. And so, as you're finding deals, you're going through due diligence of what deals you're going to say yes to, no to. What role of sharing the story of the criteria is important for the investor? How much do they need to know? Because most first-time investors, or they're looking to get the real estate, this might be overwhelming for them. And so they're going to take more of a passive investor role, like you kind of started out. And so, when they're trying to figure out on what investor to invest with, trusting them, like you said, but what are things that, helps tell the story for them to say, yes, let me go ahead and invest?
I think it really comes down to, what makes me invest with people. And that's really the sponsorship team. And so if they like, know, and trust you and believe in you and say, this person has run $30 million businesses. So running a 15 or 20 or $25 million asset and, has had that experience, it's going to be pretty easy for them. So, I think that story resonates well with people. And, I think also, we really try to kind of the motto of, Wall Street ethics, Eagle Scout ethics with Wall Street analytics. I mean, that's something we really want to bring to our investors. So, from a standpoint of just being very transparent around, the risks of the transaction, the mitigants of the transaction, the things that we like about it, but really being there to answer any questions. And, frankly, if there were people that, like I was mentioning the story of this one person that said, I want to be in and out in a year, I'd say, this is not the right investment for you. And happy to, kind of point you in a different direction, but, I'm just not your person. So, I think we feel pretty confident that, we're in this for the long haul. So, just getting a quick win by inviting that person into our deal doesn't really help us. It hurts us. And so we really want to make sure that we're building a loyal fan base, and that word of mouth is so much more powerful than us, being on any podcast that we could be on or doing anything else.
Right. Yeah. I mean, I think just for, class today, I think you've helped out on just finding the right deal for you, the foundational criterias that, everyone should probably look at. Then you got some specific and what makes sense for you. What is your goal in these next, 5 years, as you want to scale, build your team? Where do you see yourself in 5 years?
Yeah, I mean, we definitely want to buy the right assets at the right price. Great locations, kind of all the criteria that I mentioned, and have a solid portfolio that's performing well, and continue to build the team so that hopefully one day we can get it to a point where there's some more vertical integration, whether that's on the property management side or construction side or so forth, so that we can be more nimble and more confident in the acquisition strategy. So, building that core presence in key areas is really a foundational goal for us.
Yeah. Are you looking to have your own property management team manage your properties?
We would start with third party management until we get to a certain scale. I think is where it makes sense. Or conversely, if it were a smaller asset and we can wet our feet with that, I think that makes sense. So it's kind of those barbells of really small asset, self-manage it to get to 1,000+ units and then do it. But I guess fundamentally, if you have the right third-party property management, and I've met people that have, and we've experienced it with some good third-party property managers, then it works really well. And it's just fundamentally, I think I'm always at this point of no one cares about your money and your kids and your properties as much as you do. So that's something that is just a little bit hard for me to shake.
Yeah, I had Robert Martinez on, and he says don't go third party, and kind of the same thing as you said. Like nobody is going to care about your property as much as you.
Absolutely,
and I think that's a struggle from an investor standpoint.
Absolutely.
Yeah.
Absolutely.
Yeah, I mean, just to wrap this up, I think you had a lot of courage to, leave your career that you're successful at in Wall Street to go down this endeavor, and it's starting to, show and pay dividends. And you kind of see, where your vision is. What are you most proud of that journey? Because, I know I left my job and it was so scary when I was in management consulting. But, as soon as you start getting your feet wet, you go, okay, it's just like riding a bike again, baby steps, day by day. And so what would you say you're most proud of when you look back on where you're from?
No, that's a great question. So, when I think about, starting this in April, May of 2019, I didn't even know what a cap rate was. I was so focused. I could tell you everything you want to know about commodities, everything I know about commodities. But, other asset classes, one, because I couldn't invest in them. Just was very restricted when I worked at different Wall Street banks, and frankly, just passively invested in the stock market, and that was kind of what I did. So, really had blinders on, was well paid in my career, and so just focused on what I knew best. And so didn't know what a cap rate was from analyzing. I think we've probably hit 300 deals by now, and being able, like, if anybody gave me a deal, any apartment deal in the Texas Triangle, if it's outside of that, I could analyze it and value it. I would just need some market report to, get a better handle on, the local fundamentals, the submarket fundamentals. But just, I think that process of being able to take a deal and being able to rip it apart, the rent roll, the T12, we built a ton of tools to be able to do that, and, have some really, really deep insights and analytics, and put a value on something. I think that is something I'm really proud of, because I think that's a hard skill, and that's something that took a lot of time for me to get comfortable with, in terms of, people can do it, but then when you're actually going to risk your own capital, it's just a different story, right? So I would say that's probably what I'm most proud of.
Yeah, no, thank you for sharing. That probably means a lot. Just so I know, like I said, for myself, I didn't know what a cap rate was, last year, and so just now being able to interview you, to me, it's a very humble feeling, and that people are already doing what I would love to do in the future. Just to close off, where can people learn more about you? Where can they find you? I know you have a group that you started, a capital group.
Yeah, sure. So you can check out lifechangingcapital.com. You can email me at ryan@lifechangingcapital.com. And I have a few resources that may be helpful. Is 25 questions every passive investor should ask. Kind of Zach alluded to some of those questions, and there's some things I cover there. And then also have a podcast if you'd like to, hear some more about kind of the questions I ask and so forth. So feel free to reach out anytime.
Yeah. Well, I'll say that's the end of class. I appreciate Ryan you coming on. I think it was very educational just for me, and I hope as people get to listen to this, if they're a first-time investor, passive investor, or just need to touch up on the fundamentals, I think you share some knowledge that would be useful for a lot of people.
Thank you so much for having me, Zach. I appreciate it.
Yeah. All right. Well, I'll say this is the end of class, and talk soon.
All right.